Traders, good evening. In this video, I go over the weekly chart of the GLD, which is the ETF that tracks gold. On my screen is the wave count that I published back in January. So this thing must be at least 7 months old and still valid for the most part. So this bear market that gold embarked on starting in late 2011 began with a simple ABC, which I labeled wave W. It was followed by a sideways movement, which I labeled wave X. The sideways movement reclaimed part of the losses and also unfolded not just in time but in price. It's a sideways movement, which Elliott refers to as a flat formation. So W and X. What came next is a very intense wave A. Now, notice how within red wave A, I counted the internal subdivisions at 2 distinct degrees of trend, blue and green. I also made use of Ian Copsey's harmonic Elliott wave model as opposed to the classic Elliott wave model. The difference between the two models is that in the case of Copsey's model, waves 1, 3, and 5 each subdivide into an ABC structure. For example, green wave 1, ABC in blue. Green wave 3, again, ABC. And finally, green wave 5, ABC zigzag. That's unlike the classic model in which waves 1, 3, and 5 each subdivide into 5 internal waves. Now, on many occasions, I've come to find Copsey's model suitable for a particular wave structure that I couldn't possibly count using the classic model. So whenever the classic model fails to produce a viable count for me, I would resort to the Copsey model to find a solution. And oftentimes I do find a solution. Anyways, that's beside the point. The purpose of the video, of course, is to produce an actionable forecast, and that's what I intend on doing. So back in January, when the low of red wave A was retested on the heels of a 38.2% retracement of red wave A, I figured that red wave B must be unfolding as a flat formation. A flat is a sideways pattern. It subdivides into an ABC, with wave C either falling just short of wave A or exceeding it by a bit. So I said, it might reach as high as 50%, meaning the 50% retracement of red wave A, to coincide with the area of green wave 4. Because here, if you notice, green wave A reached the endpoint of blue wave B of green wave 5. Anyways, I almost was right. Wasn't right completely, because gold kept rising and GLD reached as high as, I believe, 133 or so before reversing course. And then by the time it reached 126 on the way down, the picture suddenly started not to make sense. That's when I abandoned the long position. So I only abandon a position when the reason for being in the trade in the first place no longer exists. And that's exactly what happened right when we got back to the 126 area. And since then, I left gold alone and kept watching it all year, vowing to re-enter some sort of trade in gold when the opportunity presents itself. And I believe such an opportunity is right around the corner. So let's go ahead and update this chart and see what has happened since. And here you go. I fast forwarded to August 2014. It's clear by now that what I originally thought to be an unfolding ABC flat formation turned out to be another form of sideways movement, a contracting triangle in this case, ABCDE. Now, green wave A is supposed to run out of time upon reaching the AC line. Sometimes it overshoots it, sometimes it undershoots it by a small margin. The important thing is not to exceed the endpoint of wave C. You just cannot take it out, not even by a penny. Assuming what I'm saying will play out, red wave B will come to an end and give way to the final leg down, wave C, to complete wave Y. This will make the overall bear market that started back in September 2011 a double zigzag, ABC labeled wave W, followed by a sideways movement A, B, and C labeled wave X, and the final zigzag A, B, and C. Now, in 90% of the cases, a double zigzag ends a correction. In rare cases, let's say 10 or 5% of the time, a double zigzag morphs into a triple. I have no idea whether this is going to be the case this time, but the odds will favor an end to this bear market upon the conclusion of red wave C of Y. Okay, now, assuming that things will play out as I'm forecasting, the question is, how far down will the GLD fall? And the most common relationship among waves A and C of a zigzag is the equality relationship. By taking the size of wave A and projecting it from the anticipated end of wave B, which is somewhere here, let's say, we will get as far down as the October 2008 low. That's one potential solution. Now, another way to estimate the downside potential for red wave C is to use Elliott's own guidelines for estimating the post-triangle thrust. That's what he calls it, the post-triangle thrust. By the way, I did notice in this case that green wave B ended slightly below the endpoint of red wave A, making this triangle technically a running triangle. Now, to measure the post-triangle thrust, you would extend the BD and the AC lines back into the past, like I did right here, and then you would draw down a line starting at the endpoint of green wave A all the way to the BD line. You would take this measurement and project it down from green point E, the endpoint of wave E. Now, we don't know yet where green wave E will end, but I'm assuming it would end somewhere here. And if so, we get a downside target of approximately 103. Now, this doesn't have to happen in a strong bear market. Wave C can easily exceed this downside measurement. Again, the potential is for it to go as far down as the equality relationship, meaning the October 2008 low. All right, this concludes my review of gold. Let's see what happens in the coming weeks and months. If anything significant happens between now and then, I will certainly revisit the charts.